Markets are predicting that the Federal Reserve will take a softer approach to raise interest rates following the collapse of Silicon Valley Bank, which could benefit cryptocurrencies that have been struggling in a tightening economy. The chance of the Fed raising interest rates by 50 basis points at its meeting next week has fallen to 0%, according to the CME FedWatch tool. So in this video, we are going to discuss, could the Silicon Valley Bank crisis end crypto winter? The video is going to be amazing, so make sure you stick to the end. Any uptick in liquidity would be beneficial for crypto markets. Bitcoin surged by 13.5% and Ethereum rose by 8.1% following the news. Nonetheless, the regulatory headwinds that the digital assets industry currently faces may still hamper any recovery. The conventional wisdom about crypto is that it's self-referential, a separate universe from conventional finance, and that its inherent volatility can be contained. The emerging contagion theory is that there are enough linkages for extreme turmoil to spill over, much as a virus can sometimes jump from one species to another. That's what happened here, according to Barney Frank, the former U.S. congressman who wrote sweeping new banking rules after the banking crisis in 2008 and joined the crypto-friendly Signature Bank as a board member in 2015. "I think if it hadn't been for FTX and the extreme nervousness about crypto, that this wouldn't have happened," Frank told Politico this week. That wasn't something that could have been anticipated by regulators. Jerome Powell, the chairman of the Fed, has stated that interest rates would stay high until the U.S. inflation rate is well on its way to 2%. But James Knightley, the chief international economist at InBank, said in an interview with the publication Decrypt that the central bank's approach will likely shift to caution. "If there is a situation that warrants it, they will change their view very, very quickly," Knightley said. "What we've got now is a situation whereby we could be at the peak, potentially, right now. A lot of us believe that cryptocurrency and blockchain are superior technology for running the financial system," said Brad Nickel, who hosts the crypto podcast Mission DeFi. Silicon Valley Bank, FTX, the mortgage crisis of 2008. They all become an opportunity to point out that our financial system that we all everywhere in the world rely upon is opaque and centrally controlled by human beings, he told Euronews Next. Regulators, investors, and banks could have seen how badly things were being run. The same is true of Silicon Valley Bank. We had no insights into what their financial situation was except for what they reported. The notice targets the Binance USD, BUSD, stablecoin issued by Paxos for use on the Binance exchange, and states the coin needs to be registered as a security. Shortly after, New York's financial regulator ordered Paxos to stop minting BUSD, and by the end of the week, Binance's stablecoin had booked $2.5 million outflows. If U.S. investors lose access to BUSD altogether, this could raise the question of whether other stablecoins will face similar legal challenges, with a potentially meaningful impact on the asset class. The loggerheads are still significant, even if only Binance-specific though, as CEO Changpeng Zhao announced he will curtail all his firm's planned investments in the U.S., including bids to revive bankrupt companies. Even if the drama in the current third-largest stablecoin, note this used to be Terra, does not result in crisis, it bears thinking about how crypto ETPs will fare during the next stress event. According to Laurent Cassis, a crypto specialist at CEC Capital, the ETP structure itself is proven and tested, and may actually be the most robust part of its own value chain. Even when products have had to delist during Terra and FTX, it is because there was no sourcing of the underlying asset, but the actual structure and the product itself did what it said on the tin. Instead, the issuers of ETPs themselves deserve closer inspection, especially after Binance-backed Econex went into liquidation after failing to pay creditors last year, and Bitpanda closed its ETP range due to low demand and high costs. Some issuers do not realize the financial burden involved in building and keeping an ETP on the market. Cassis added, "You need to scale it, cover service providers, and pay off ongoing obligations. I would not be surprised if we saw a lot more ETPs pulling the plug this year." FTX, the crypto exchange that collapsed in November amid allegations of massive fraud, capped a year of turmoil in crypto markets, as investors began withdrawing funds from riskier ventures in response to rising interest rates, which in turn exposed the shaky foundations underpinning the industry. Before we move on, support us by hitting subscribe and the bell icon to get notified when we post new videos. Now let's get back to our topic. The ensuing crypto winter saw the value of the industry plummet by 2/3, from a peak of $3 trillion in 2021. Stockholders in the failed banks, on the other hand, will see their equity go to zero, which the Treasury Department points to as another reason. This isn't a bailout per se. The FDIC announced it will make the backstop mechanism seemingly permanent with the creation of the new Bank Term Funding Program. The program will offer loans for collateral, including treasuries. This seems both practical and reasonable because the forced sale of underwater treasury instruments played a starring role in the collapses of not only SVB and Signature, but also crypto-focused Silvergate Bank, which went under last Wednesday. As many have pointed out, the Federal Reserve's own aggressive movement on interest rates contributed to the duration mismatch that forced those sales. Crypto's mission as an industry is to offer an alternative financial landscape that corrects the mistakes of banks. Yet, ironically, too many founders replicate TradFi's flaws in a blockchain setting because they refuse to learn the lessons banks have already learned from their own past mistakes. There are a few clear reasons for that. Most notably, most crypto leaders come from a tech, rather than finance, background, and haven't put much of their youth into studying the history of finance to date. So enthralled by the beauty of blockchain as a technology, such founders forget that banks are actually quite good at what they do. Banks are effective at doing things like leveraging assets and assessing risk. Banks are also transparent about the fact that they lend out your money when they do. Instead of recreating entire financial ecosystems from scratch, crypto projects should build on the things banks already do well. From there, they can pinpoint the problems and focus on solving those. Silicon Valley Bank was founded in 1983 by a couple of former bankers who had been working at a high-tech business but saw this gap in traditional banking. There were a lot of companies in the early 80s. This is the personal computer boom. So there are these consumer-facing products like desktop computers and software that the Bank of America's and the Wells Fargo's were like, "Oh, I don't know what that does. That's a new risky thing. I don't think I'm gonna give you a business loan for this." SVB comes out of that, and it's very much the networks that make it go. The relationships with VCs allowed them to do that. Startups had that third-party validation from VCs, so it's very deeply embedded. Although it's one of those entities that doesn't make headlines, usually because it's a bank. It's not Fortune magazine cover story stuff. Coins associated with billionaire investor Justin Tron were punished after a 51% plunge in Huobi Thursday evening in New York. It went to $2.31 from $4.73 in a matter of minutes before stabilizing and was quoted on Friday afternoon at $3.90, down 21.8% for the week. Sun said the Huobi decline came from leveraged liquidation of a few users, before announcing on Twitter that he had created a $100 million fund to stabilize Huobi, without specifying the source of the money. Tron and Just, also in Sun's sphere of influence, were off 10% and 6%, according to Nomics. Also contributing to the pressure on the digital assets market, President Joe Biden released a proposal on Thursday for a 30% tax on crypto mining usage. The effect paled in comparison to the macroeconomic news, according to Rashwan. "We're in for a long year," he adds. "There's still additional damage that could be caused in the broad economic and political sphere that could continue to hurt risk assets like cryptocurrencies," he says. The Consumer Price Index, CPI, which analyzes price changes across a basket of goods and services, reported this month that consumer prices increased 6.4% in the 12 months ending in January. Despite the fact that the collapse of Silicon Valley Bank has somewhat overshadowed, chief economist at Ameriprise Financial Services Russell Price said in an interview with Decrypt that it could still influence the Fed's future course if the report shows signs that inflation is stubborn. Real estate markets started cracking last year, and house prices will fall further this year. Fund managers surveyed by BofA see China's troubled real estate sector as the second most likely source of a credit event. European real estate reported distress levels not seen since 2012 by November. Law firm Weil, Gotshal and Manges found. This coordinated behavior seems disturbingly reminiscent of Operation Choke Point, which, as you know, was an Obama administration initiative, where federal regulators applied pressure on financial institutions to cut off financial services to certain licensed, legally operating industries, simply because certain regulators and policymakers disfavored those industries. Reads a letter sent to Federal Reserve Chairman Jerome Powell by a group of Republican senators, led by Bill Hagerty of Tennessee. How the sector funds itself is key. Officials warn European banks to risk significant profit hits from sliding house prices, which is making them less likely to lend to the sector. Real estate investment management firm AEW estimates the sector in UK, France, and Germany could face a €51 billion debt funding gap through 2025. Asset managers Brookfield and Blackstone recently defaulted on some debt tied to real estate as interest rate hikes and falling demand for offices in particular hit property values. The reality that some of the values out there aren't right and perhaps need to be marked down is something that everyone's focused on, said Brett Luthwaite, global head of fixed income at Macquarie Asset Management. So while a broader contagion is unlikely, smaller banks that are disproportionately tied to cash-strapped industries like tech and crypto may be in for a rough ride, according to Ed Moya, the senior market analyst at Awanda. Everyone on Wall Street knew that the Fed's rate hiking campaign would eventually break something. And right now, that is taking down small banks. Moya said on Friday, the FDIC typically sells a failed bank's assets to other banks, using the proceeds to repay depositors whose funds weren't insured. A buyer could still emerge for SVB, though it's far from guaranteed. From a trading perspective, Roxane Sanguinetti, head of the strategy at GHCO, said the FTX collapse saw market makers lose a very active liquidity pool. Prior to FTX, Sanguinetti told ETF stream liquidity was already a challenge in crypto ETPs as prime brokers demanded each position was capitalized between 100% and 160%, making large orders costly for market makers to execute. The collapse of Sam Bankman-Fried's exchange then added further risk and illiquidity, widening bid-ask spreads for end investors. Pre-FTX, we could easily quote Bitcoin ETPs at 10 to 15 basis points, sometimes even lower than that, Sanguinetti said. This is not the case anymore. It is probably double that. She added during the FTX crisis, Bitcoin ETP spreads widened to more than 1%. Part of this is owed to the costs borne by market makers when artificially creating liquidity where none existed, whereas traditional ETFs settle almost instantly. Sanguinetti noted there is a constant liquidity gap of 2 days in crypto ETPs between when investors redeem their certificates and when issuers pass market makers the underlying coins. To maintain liquidity, GHCO borrows coins in the interim period, but when these borrowing costs surge during sell-offs, they become stuck. That happened during the time of FTX, when the lender BlockFi went down and borrow costs doubled, Sanguinetti said. Even now, the cost to borrow and execute coins is very high. Spreads remain wider in the ETPs, and we are looking at our counterparty risk with even more scrutiny. Therefore, when accessing Binance or others with potentially higher risk, we had to drop certain counterparties, meaning there are fewer pools of liquidity you can access. When asked when costs would become prohibitive to GHCO operating in crypto ETPs, Sanguinetti said her firm is yet to downsize its activity, but it depends whether an issuer is willing to pay more because now our costs are higher. Another crash could tip the balance on cost, however. More worrying are previously unseen structural risks. During FTX, GHCO paid a premium for its loans to be uncollateralized, meaning they did not lose their collateral in instances where counterparties failed or recalled loans early. Market makers still in the crypto Wild West stand to benefit from being part of a select few in issuers' order books. However, if another crisis ensues, the traceability of crypto ETPs could be stretched to breaking point. CB Insight's latest blockchain report looks at one chapter of the story, noting global venture funding to blockchain and crypto companies reached a new record of $26.8 billion in 2022, largely propped up by a strong first half. But as the year progressed, the crypto winter coupled with macroeconomic pressures caused 3 straight quarters of declines in funding and deals. As for how enmeshed SVB is, CB Insights noted for its 2,690 plus fintech clients, SVB is more than just a bank. In addition to the venture debt financing and startup banking that it's known for, SVB is a gateway for commercial payments and online payment acceptance. In fact, it markets itself not as a bank, but as a financial technology partner. According to SVB, its clients account for 71% of all fintech IPOs since 2020. This is the new world, not just for blockchain and crypto, but for fintech and startups, and specialist banks like SVB. The tide is going out on the liquidity tsunami of the last decade, and this latest wave of bank failures won't be the last. The fortunes of a bank and its environment are entwined. Finally, any moral assessment of this moment must reckon with the panicky and arguably malevolent behavior of some of Silicon Valley's biggest names. SVB and Silvergate had the same balance sheet structure and risks. Massive duration mismatch, lots of uninsured runnable deposits backed by securities not marked to market, and inadequate regulatory capital. Because unrealized fair value losses excluded, former NatWest banker and industry expert Francis Coppola told Politico. As soon as Silicon Valley Bank was shuttered Friday, prominent voices in the venture capital world began explicitly demanding that all uninsured deposits be guaranteed by the government. If SVB wasn't bailed out, these figures warned in dire, panicky terms, there would be a nationwide bank run, decimating mid-sized and community banks across the U.S. Notably, these commenters largely ignored the existence of a receivership process and went straight to demanding a bailout that would make all uninsured deposits whole. This included David Sachs and Jason Calacanis, prominent tech investors and co-hosts of the All In podcast. Some of Sachs' foreboding tweets were so unconsidered that Twitter users flagged them with fact checks. Calacanis' behavior was even more deranged. On Twitter, he posted images from the film Mad Max: Fury Road, while exhorting his more than 690,000 followers to stock up on food and fuel. By early Monday, Calacanis had deleted many of these tweets. This theatrical tearing of hair arguably fueled the very panic Calacanis and Sachs were warning of, and did so by design. At worst, these inverse Cassandras were little more than rhetorical terrorists, using their massive platforms and the trust placed in them by still all too credulous Americans to stoke fear. At the very least, their behavior increased pressure on the Fed to quiet the fears they were feeding as much as warning about. Could startup business customers be treated differently from big investors? The government is in talks to get other banks to take on the ailing UK arm of SVB or to offer some sort of guarantees to allow clients to pay wages and suppliers. All this comes as the Chancellor is planning to make the UK's tech future a centerpiece of his budget on Wednesday. Ordinary UK depositors at other banks should be reassured. This is a very specialist bank, only serving customers in a specific sector. However, what is happening in the US is another matter. US regulators do not want to bail out sophisticated tech investors who take financial risks with the promise of fabulous returns. But they will be keen to provide enough reassurance to avoid a run on deposits spreading to smaller banks. If that happened, it could cast a shadow over other stock markets and the world economy too. So this does matter for UK economic policy and US financial stability. It could also be a canary in the coal mine for other unknown risks, as the financial system is upended by the recent end of nearly free money. As word got out, the withdrawals turned into a bank run as frictionless and hype-driven as a crypto bubble.